The coronavirus has definitely been top of mind, kind of top of conversation as well. So we sat down with my partner and we're going to talk about it. Stock market responded. We saw a big drop last week. Woke up this morning, stock market started coming up. So we're talking about why that's happening, what government's doing, if interest rates are going to go down, how us as investors should be reacting, and what the future looks like. So check it out. I hope it gives you a better understanding of what we're looking at, and let us know your opinion. After the conversation, I'd love to hear your thoughts and if what we're looking at aligns with what you're seeing. We had a good start in the stock market for the beginning of 2020, and last week we saw that change a little bit. More than a 10%, was a 13% on Friday is how much it dropped, which would be, I guess, a market correction. And all we're hearing is that it's because of the coronavirus. What about the coronavirus has caused the market to react the way it did?
Well, you have all the concerns around the health epidemic. You have things like travel bans that are starting to happen, and quarantines in China, and you have people that aren't going to work. So all of that kind of compounds together and creates some reduction in economic activity. You have companies that are starting to report now here in the U.S., even though the disease has only very recently started to surface here. You have companies that are already saying that it's going to have an impact on their earnings. So all of that's probably going to be very temporary, but the big issue for the market is there's still a whole lot that's unknown about this. The details as far as what to expect from this virus are still pretty sparse, and so there's a lot of people that are just kind of hedging their bets at this point.
So we've kind of two parts of it. One, the actual illness and a lot about it that we don't know, and then the fear component, and then also the fact that China produces so much of our goods. So there's a lot of companies starting to report that they're going to feel it, essentially.
Right.
So the market had such a big drop because of all the unknown.
Yeah, that's generally an accurate statement. So if a company's starting to experience disruptions to their supply chain, for example, and they come out and they say, okay, we're not going to hit our earnings targets this quarter because we can't get product. No one really knows exactly how long that's going to last, and so it's again with this kind of stuff, usually it's pretty short-lived. We've seen like with SARS and Ebola and other epidemics like this in the past, they've been very short-lived. But at this stage, I think it's reasonable to assume that we'll see similar patterns, but you just can't really know yet.
On the production side, okay, in theory, it's not a demand issue, right? It's a production issue. And
right.
If people are willing to buy your product, but they can't get it, it might almost bring demand up, right? So if that's the case, could this be an opportunity to buy?
Yeah, I don't know that it necessarily increases demand in the aggregate, but it definitely has the potential to create some pent-up demand.
Okay, sure.
So the things that you were going to buy anyway, you're not necessarily going to buy more of it, but if you were going to buy it anyway and you defer that for 30 days while you kind of wait to see how all this plays out, if you're still going to buy it, you're still going to buy it. So you could see that, and that I think that's consistent with what we've seen in these types of situations in the past. Is you have a brief dip in economic activity, but then it rebounds with all that pent-up demand.
Okay. So Friday, I was with you on Friday, and we left the house with the market going like this. Today, we woke up and the market started rising again. From what I saw, and this is speculating, but they were talking about a coordinated central bank action to step in and help. What does that mean?
We don't really know yet. I think the news today was that the G7 nations, so it's France, Germany, U.S., et cetera, they're going to have a meeting of the central banks to discuss some sort of coordinated action. What exactly that's going to look like, it's too early to know. Typically the tools that they have at their disposal are cutting interest rates and doing things like buying bonds in the open market. The things that we saw during the Great Recession and since. So probably something along those lines is what would be reasonable to expect. I think today I was reading that markets are pricing in 2 or 3 rate cuts from the Federal Reserve here over the next couple of quarters. So I think that's pretty likely what we'll see happen is some sort of injection of liquidity into the system through those types of measures.
Okay. So rates are already so low.
Yeah.
If rates continue to go down, how low can we go? And is this a good or bad thing?
Good question. So, right now, as a reminder, typically the Federal Reserve will do most of their operations at the very short end of the yield curve. So they control overnight lending rates between banks. And so when they set their interest rate policy, it's on very, very short-term debt. That hasn't moved very much just yet. Most of the big decline in interest rates that we saw here over the last couple of weeks was on the 10-year and 30-year bond, and we hit historic lows on the 10-year bond last week and again today. So that's kind of predicting what market participants think that the short end of the curve is going to be doing when the central banks start to intervene. How low can they go? Internationally, we've seen European central banks go to negative interest rates. That's been kind of a big experiment. We've talked before about could that happen here, and in concept, yes, it could. There's been a lot of commentary from the Federal Reserve here over the last several months, though, talking about some of the unintended consequences of negative interest rates and how maybe that is not the best course of action for us. So at this moment, I would be surprised if we saw the U.S. rates actually go negative, at least from central bank intervention. But they can definitely continue to approach zero.
What are some of the bad things about it going negative?
Some of the bad things, it kind of discourages savings for one thing. So if you can,
Sure.
are you going to pay someone to hold your money for you, or generally when we invest, we expect to get something back, not to pay out for that privilege. So discourages savings, discourages investment, discourages a lot of good behaviors. The positive is it encourages consumption, which can kind of kickstart economic activity and keep things moving. But there's some negatives that come from it too.
So in the last question, you were referring that the Feds aren't going to change long-term rates; they're possibly going to change short-term rates. Can you talk about the difference between the two?
So if you're looking at long-term rates, typically those are going to be bonds. For consumers, that's probably your mortgage. You're going to go out and borrow, say on your house for a 30-year loan. Typically that's indexed to, or your borrowing cost on that is based on some spread over U.S. Treasury bonds. If you see the long-term bonds go down in yields, that can typically bring those mortgage rates down, for example. What causes that to happen is typically investor activity. So, what we saw here over the last week is a lot of investors taking money out of stock portfolios, selling other types of assets and buying U.S. Treasuries for safety. Well, that demand drives the rates down. There's a finite, there's a limited number of bonds out there, and so the more people want them, the lower the interest rate goes. So that's just kind of a market behavior. On the short end of the yield curve, so typically on the overnight interest rate, so you borrow the money today and pay it back tomorrow, literally, or as much as 30 days out. Those are typically banks and corporations that are borrowing on those kinds of terms in very large dollar amounts. And so That's where the central banks typically intervene. So when they're setting their interest rate policy, it's really with a target to get banks to be more active or less active, and try and kind of control economic growth that way. So it's mainly the short end of the curve that they typically work in. During the financial crisis, though, they did start some programs that were, kind of new, where they started buying longer-dated treasuries. And that has not totally unwound yet. So there is still some intervention that's going on there on the longer end of the yield curve. But historically, it's typically been on the short end of the yield curve that the central banks are involved.
Okay. Is there a scenario where interest rates get so low or ultimately become negative that Dave Ramsey starts borrowing money?
You'd have to ask Dave Ramsey that.
Like, can you imagine this whole debt-free community like goes pro-debt all of a sudden? Or do you think do you think Dave's view on debt is more biblically based, or does he really just not like the fact that debt can get you in trouble?
I think it's more the latter. Debt's a great tool, but it's it's useful, but it probably shouldn't be a tool that's used by the average person, because it really can get you into a lot of trouble. A good investment that's leveraged, can generate better returns, but it can also generate greater losses if so that debt can work for you or against you. And so it's probably not something the average person should be making use of.
Okay, so don't expect to see Dave's position change.
Yeah, probably not. But if it goes negative and you start making a profit from borrowing money, that might I don't know, that might change his mind. It'd be a fun question to ask him.
Okay, so for the media does such a good job at scaring us, I'd say. How much does the media affect the market?
Hugely. So the market is going to be really just a composite of people's behavior. And so when people are feeling optimistic, market prices tend to go up. When they start feeling pessimistic or frightened, they stop buying things, and they stop buying specifically investments, and they maybe wait and see what happens. And when that happens, you kind of have a constant flow of sellers going on in the market. People need liquidity for various reasons, but if nobody's buying, that's when we start to see prices decline. So when the media starts talking about things like health epidemics and the World Health Organization and travel bans, and how this is going to be bad for the economy, that can be create a little bit of a frenzy on the part of investors, just from getting scared, frankly.
Got it. So for new investors who might be going through an experience like this for the first time, what can you talk about through your experience on maybe, I don't know, encouraging them to not panic, or that this is normal? Anything you could touch on there?
Yeah, well, I think the main thing to know is that, like you said, this is normal. I was seeing headlines last week of, this is the biggest market sell-off since.
I saw that.
Media loves saying things like that, and but they're talking about biggest sell-off since a few years ago. This is this type of decline, roughly 13%, from peak to Friday of last week, and back up another 5% today. This kind of behavior is something that we observe with fairly high frequency. About once every couple of years, we see the market correct in some fashion like this. It's not usually because of fears of some virus, but something, some risk gets highlighted and the market's correct. So it's normal. It's something that you should expect.
Okay. So really, we're saying have a long-term view on this. Don't worry about panicking and pulling all your money out. You're going to experience a lot of this over the next 20, 30 years.
Yeah, you'll experience this many, many times.
Okay.
And people who pulled out the market during the financial crisis, there were good reasons to be worried. Back then there were a lot of real issues that our economy was going through. but back then, same as today, the economy will recover from this. It's back then the issues were a bit more structural and took a little bit longer to work through. Than this likely will go faster, but once the economy recovers and the engine gets going again, it's a temporary thing. So.
Okay.
Long-term investors, particularly younger investors who have a very long investment horizon, you're investing money not for next year's purchases, but for purchases 20, 30, 40, maybe as much as 60 years from now. These little short-term fluctuations don't move the needle.
Okay. So finally, I guess, for real estate investors, how does this affect us? Does it affect us at all? Any concerns moving forward?
No, not really. So your real estate markets, don't trade with the same type of liquidity that that the stock market does, and so day-to-day movements are much less observable. I would say if we did end up in a long, protracted recession as a consequence of this, which I don't think is likely, but if we did, then you could see certain asset classes like hotels and office buildings and things like that. There may be reduced demand for those for a time, but as long as you've still got good assets, if you're properly positioned. Again, kind of like what I was saying with the stock market, when the economy does rebound, the demand is still there for those things. Other asset classes are typically less sensitive to economic swings. So things like multifamily, for example, people still need a place to live. So you might see short-term blips in prices, but more than likely, especially if interest rates continue to stay as low as they have, as low as they've gotten here recently, you might actually see real estate prices go up as a consequence because they tend to trade at a spread to interest rates. So there's some possibility that could be a bright spot.
Okay, I was going to end it with that, but I just thought we did a piece, I don't know, a few months back about the productivity of gold. And you kind of mentioned something. Look, I'm not really a gold guy, unless like a third of our population dies off. Maybe I'm going to want it. Do you still have the same position? Or are you at gold now?
Yeah, I'm still of the same mind. I'm not a fan of gold. At least not. To clarify, I'm not against holding some gold in your portfolio. I think it's a useful diversifier, and so a lot of people like to hold it for this. The perceived security of it, and there's some sense to that. It's probably not going to generate a real high return over the long run, but it does kind of smooth out some of those fluctuations in an overall portfolio. So there's some use to it. Having said that, again, like I said before, it's not a productive asset, and so it's never been a big part of my portfolio. I don't plan on changing that. But again, if all of a sudden, one of the big drivers of corporate profitability is population growth. So generally, we've had a very long time globally where our population has been rising, and there's more people buying stuff, and so companies are making more money, and that's good for the stock market. Third of the population goes away, that's going to be bad. So that's type of a scenario, something like gold would be nice to have.
For clarification, we are not saying that a third of the population is going to go away with coronavirus. We're just making the example that would be a case where Jerry would really like gold, and I would probably follow him into that. But
yeah, definitely not making that case. I read a publication, I think it was the New York Times, that was talking about comparisons of coronavirus and the common flu. And here we've got roughly a little less than 90,000 cases of coronavirus reported here so far, and roughly 3,000 deaths, and those are big numbers. But when you compare it to something like the flu, where you have hundreds of millions of cases every single year, and 300 to 600,000 people die from the flu every year, all of a sudden that 3,000 looks kind of small in comparison. And so in terms of the economic impact of that, it's fairly, seems like it would be fairly small. So, no, definitely don't, think that we're going to see anything near, that scale